Well, welcome to another episode of the Slash Tax Podcast, where we explore the smartest strategies to legally and ethically reduce taxes, maximize returns, and build lasting wealth through strategic investing. I'm your host, Heidi Henderson, and today I'm personally excited on this one. My guest is Matthew Ricciardella, founder and CEO of Crystal View Capital. This is a private equity real estate firm that is focused on value-add investments in self-storage and manufactured housing communities across the United States. With over 20 years in real estate, more than $1 billion in transactions, Matt leads one of the most respected funds in this space. Under his leadership, Crystal View Capital has built a reputation for disciplined investing, strong performance, and integrity, and now managing roughly $600 million in assets across multiple funds and many states. So we'll talk about that a bit. I'm also really proud to share that I personally am an investor in Crystal View Capital, which gives me kind of a unique perspective and understanding their approach and the incredible opportunities that this asset class offers for investors. In the conversation, we're going to unpack what makes self-storage and mobile home communities such a powerful wealth building vehicle, but also the tax advantages that relate to these types of investments and how Matt's team strategically identifies undervalued assets and then is able to transform them into high-performing investments. And so with that, Matt, thank you so much for being here.
Thanks for having me, Heidi. I'm excited about today's event and I appreciate it.
Absolutely. Okay, so let's start at the beginning. What led you first to found Crystal View Capital, and what was your vision for the firm when you started?
Yeah, so it's kind of by accident, to be honest with you. I didn't, start out, at a college or anything. I don't have a background with a formal education. I'm kind of self-taught, kind of built from the street in that sense, where I started as a residential realtor and kind of
Okay.
have a sales background is kind of where I come from. And I really built my sales business and platform up through direct prospecting.
Mm,
So a lot of cold calling, a lot of door knocking, just face to face sales, and really building that rapport and trust with the deal counterparty. And that is not very different than what we do today and how we build our sales team around that face to face contact. But the way I kind of stumbled into Crystal View is I was investing in self storage and mobile home communities for my own account for a number of years, 6, 7 years, and did very, very well. Through my sales background, I would find these deals off market, kind of turn them around. Same strategy hasn't changed very much. We've professionalized the platform, but really the methodology and the philosophy has been the same as it's been for close to 20 years now. The problem that I had is I had a finite amount of capital. So I had a great business, made a lot of sense. The returns were exceptional, but I couldn't scale it because I was reliant upon my own capital and a little bit of outside capital. So that was the impetus to form Crystal View Capital Fund One back in 2014.
9 years. Look at that. No, that's 11 years, if I
Yeah,
can do my math. That's amazing. Well, I was just talking to you before we started that I actually wrote an article. So I was asked to write an article in one of the self-storage national publications. And it was a little bit about my story as to this debate between choosing to be a passive investor, like limited partner in a syndicated fund like this, versus a lot of our investors that are just direct investors. I mean, they're going out, they're buying assets, they actually own real estate, or that's their ultimate goal. And there are some pros and cons both ways. It's interesting because I work with thousands and thousands of real estate investors that are building their own portfolios and they're structuring their own real estate. One of the reasons that I actually chose to invest with you, I do have my own real estate as well, but I invest with Crystal View because what you do, I saw that and I thought to myself, okay, first off, I can't compete with that. I am not going to go out. I'm not going to hit the ground. I'm not going to drive all over the country in these interesting places and build relationships with property owners and find those opportunities and be able to have those real conversations with people that you guys are able to do. And I think it's something that is so incredibly unique and what also, I mean, certainly converts to amazing returns, I think, in your portfolios. But talk a little bit about your reputation of integrity and transparency with how you approach this, because I
Yeah.
think this really is such a huge differentiator in what you do versus what I've seen in other groups.
Well, I appreciate that. And then we also appreciate you investing with us and recognizing that distinction of what we could offer versus doing it on your own. But yes, I mean, that integrity, that bond, doing what you say you're going to do is just integral in this industry. And reason for it, I think, are several reasons. One, it's a very small industry. This is
Hmm.
not, I mean, if you have a good reputation that works to your benefit, as it has for us for many, many years, over a decade. And on the flip side, it could work against you very quickly. I think Warren Buffett had an old adage. It said, a great reputation takes decades to build, and it takes 5 minutes to destroy. And I've always held that very close to my heart in everything that I do. I want to treat, if I'm buying a property from somebody, I want to treat them fairly. And the reason for it is I think first, it's the right thing to do morally, but it's also the right thing to do from a business perspective. I can't tell you, Heidi, how many sellers that we've bought properties from. We've treated them fair, honestly, with integrity, created a win-win deal. They've turned around post transaction because of how we treated them and said, you know what? I don't know what I'm going to do with this capital. I'm going to reinvest it back with you. That's,
Wow.
that's one example of many. You treat your residents fairly. Guess what they're going to do? They're going to turn around and they're going to tell their friends and family, hey, this community is great. You're going to sell homes within your communities and build your rent roll and your occupancy by word of mouth rather than having to spend advertising dollars.
Hmm.
You treat your employees fairly. That's going to spread out there within the community. You're going to get a good name. We've had investors come in and new sellers come in because of the way our managers spoke about us and how happy and inspired they were working for this company. I could go on and on and on, but I'll tell you, it's just a virtuous cycle. If you treat people fairly, with integrity, honesty, and you try to create win-win deals in everything that you do, it's going to come back to you in tenfold. So there's no reason to screw somebody out there. That's just short-term thinking. That's going to kill you in the long run.
Yeah, I love that philosophy, and I couldn't agree with it more. That in the long run, being in the karma business, ultimately, it does come back to you tenfold by doing what's right and fair. I think in any case, let's talk. Let's kind of rewind to Fund One, and talk about as you started Crystal View Capital in Fund One. I believe your primary focus was self-storage properties, right?
Both. It was
Okay.
storage. Really fun one, honestly, was more of a generalist fund.
Okay.
So
Okay.
we had office in fund one. We had retail. We had industrial. We had vacant land. The primary asset classes were self storage and MH, manufactured housing communities,
Okay.
and then fund two, three, and four are almost entirely manufactured housing and self storage. So yeah, I mean, that's been the biggest part of our fund's portfolio since inception.
Yeah. And what led you to those asset classes? Talk a little bit about your journey and kind of going from having more of a diversified portfolio to really honing in these assets.
Yeah, so first off, kind of before I even launched Fund One, I think this is relevant. I invested in all asset classes personally. In the way, again, I used that sales background to find deals. So I would come in
Hmm.
every morning, I'd pick up the phone, I'd make 100, 200 cold calls a day, mom and pop owner operators of office, industrial, self storage, manufactured housing, multifamily, you name it, and I would just look for the best overall value within the marketplace. I was in Southern California at the time, so my geographical focus was mostly in the Southern California region. And what happened is I found time and time again these other asset classes, the four main food groups of multifamily, office, retail, industrial, mostly institutional owned and operated. So what that
Hmm.
meant is very efficient market and by and large operated very efficiently. And on the flip side, what I found is the manufactured housing and storage very fragmented, mostly mom and pop owned and operated, and ran very inefficiently without real defined systems and procedures, protocols. So naturally, since there was this inefficient market, I was able to really come in and buy at a very attractive basis and usually no competition. You would go directly to the source, you'd strike a deal, you'd put a deal in place that was fair for both parties. Then once we take over, what we found is we could very quickly create value. And that's kind of what we're known for here at Crystal View, is our ability to execute a business plan of value creation. And that
Mm.
ranges from rents way below market, expenses that are bloated, unprofessional marketing. We'd come in and we solve these inefficiencies. Each deal is different. That would create a lot of value, and it would usually happen very quickly. So when you stack together buying right and creating value quickly, it translates into very, very nice returns. So, and that's why we've focused on those two asset classes, and they're both still fragmented. That's why we continue to focus on those two
Yeah.
asset classes.
Have you found like that the industry is getting less fragmented with what I feel like, what seems like a lot of demand for these types of properties?
Yes. I mean, look, you could watch the headlines and you'll see endless institutional capital flows coming into both asset classes. We saw
Hmm.
Brookfield for $10 billion just bought Yes Communities. I want to say it was about 6 weeks ago. I think Blue Owl just announced that they want to spin up a joint venture to become the largest self-storage owner operator in the country.
Wow.
Um, Countless other, Apollo, Blackstone, KKR, you name it, they want exposure. The challenge they have is due to that fragmentation, they can't go to scale, or at least they can't quickly. So
Hmm.
what they need to do is assemble portfolios of operators such as us. And when we sell out to those groups, we're going to sell for a premium because of the scale that we've built painstakingly over time. So that's to answer. That's a long-winded way of answering your question. Of there is a lot of capital flow, but still mostly mom and pop owned and operated. And what that equates to in our mind, and this is really the kind of our thesis, we have a lot of runway to continue to execute the strategy to aggregate and roll up mom and pop operators with the
Hmm.
idea and intention to exit down the line 5, 10+ years from now to these institutional capital providers at a premium to deliver our investors with outsized risk adjusted returns.
Yeah. Okay. Well, how are you competing then with other groups that are out there chasing these projects that are looking at these? I hear a lot of owners directly. Like we work with a
Yeah,
lot of direct owners that are actually saying my phone rings off the hook. I'm
yeah,
constantly being hounded or offered to
sure.
sell my property. How do you compete with that?
Well, the way we compete with that is by not competing. And the way we the way we don't compete is we work very, very hard and diligently at going out to these a subset of owners that we've identified as our ideal targets and building those relationships with them and creating win-win scenarios for them. Thinking creatively, thinking outside the box. Sometimes they have needs and demands that these large capital providers can't provide, frankly. I mean, sometimes they want to take care of their managers, and we'll do that. Sometimes they want to stay on and live within the community for a certain period of time. As long as it pencils in our underwriting, we'll do that. So it's thinking creatively, offering tax advantages via the 721, which is a unique structure that we offer, which is kind of like an UPREIT structure, which
Hmm.
allows owners to, it allows us to issue stock effectively in the company in exchange for the asset, or a portion in cash, a portion in stock. So there's a number of things that we could do differently, but the idea, I come back to what I said in the beginning, the idea is not to compete. It's to go
Hmm.
directly to the source, strike win-win deals, but we still will look at broker deals. We seldom win those opportunities because of
Hmm.
how much action there is in the space and how much competition there is chasing these deals. But by far, the main way that we go after these deals is that off-market approach.
Yeah. Can you share an example of a property? Just give us kind of a storyline of a project that you guys acquired, what you did to bring value, and then in the end, what happened with that and how that correlates to returns for investors.
I mean, there's many of them. You saw a few of them at Investor Day, but
Yep.
we had a. I'll tell you a couple. I'll tell you one interesting story, and I could go on from there and tell you many if you'd like me to. But we had a community that we bought off market in Louisville, Kentucky, in our fund two,
Hmm.
and we kind of bought it during the pandemic, and it was through a cold call and really built rapport actually with the seller's CPA. Seller CPA drove the decision. So I personally, spent a lot of time with this individual. We bought this property for $7 million. We turned around, we brought rents to a market level after we acquired it. We passed through all the utilities, so water and sewer. We actually sub-metered. Our team did, and it was about $170,000 cost savings, which dropped
Wow.
right to the bottom line. We brought
Yeah.
in new homes into this community to grow occupancy. I actually bumped into somebody at a conference who said, "I don't know how you bought that park because I was offering 9.5 million and you bought it for 7." And it comes back to that relationship.
Mm.
Um, Less than a year after us acquiring that park, Heidi, we actually sold it for 15. And
Wow.
I think it was like a 340% IRR within that short period of time, just because of how much valuation jumped. But again, it was a stacking of buying right, having a vision around value creation, execution of that business plan, and then realizing that value within the marketplace. And then
Yeah.
obviously our investors reap the benefits of that.
Hmm. Right. Well, and I would imagine that there's a scale of economy with that as well, right? You have a team now that's really knowledgeable about this type of property class. Are you able to kind of, I guess, blend some of the management activities of each of these properties to kind of help with reduced overhead?
Yeah, I mean, what we look to do, and it's interesting, we actually just sold a portfolio in the state of Connecticut. And what we did is we bought three parks, and then we added four to that existing portfolio. So what we look to do is bolt on new acquisitions. And
Hmm.
to answer your question, very synergistic. So you're going to save tremendously on on-site management costs because you're going to have that same manager in that region, in that foothold, that's going to manage 7 assets versus just three. So we really
Yeah.
look to build concentration and scale in certain regions that we have conviction in the marketplace,
Hmm.
and that we could really cut back on management costs where it's synergistic. So, and then when we go to sell, we also achieve a premium because you're selling a larger asset. You're going to attract a more institutional type buyer and achieve a lower cap rate.
Yeah, yeah, that makes a lot of sense. So let's shift just a little bit. Can you talk about how investors can work with you? How is your fund structured, and what type of person is a good fit that could invest in, and what's kind of overall the requirements that you have for?
Sure. So, most of our investors are small family offices, and that just means, groups that have had large liquidity events and a good amount of wealth, let's say 100 million plus.
Hmm.
But by far the majority is just your retail investor. Just think about your business person that's done well and had a good liquidity event where has capital and they don't want to be involved in day-to-day management. They could see the value in owning these assets from a tax perspective, from a cash
Hmm.
flow perspective, from an appreciation perspective, but say, hey, you've built superior systems which are battle tested over 20 years. I don't like kind of what you said in the beginning. I don't want to go out there and replicate this. I don't want to fly all over the country and build these relationships. I don't want to assemble a world class management team of 200 and build systems and procedures and policies. I would like to just kind of piggyback off your efforts. You've done the hard work, you've got the systems in place, you got the track record. I've got the capital from selling a business or I've inherited wealth, whatever it may be. I want to realize all that upside and all of that
Hmm.
cash flow along the way. So those are typically kind of fits our LP investor profile. But what they do have to have is they have to be accredited, and that's
Hmm.
a process put in place by the SEC, and that's not my rules, that's their rules based off
Yep.
our specific offering, which is a 506C. They have to have a minimum net worth of $1 million or have a salary where they make $200,000 plus per year, and we have to verify that status.
Hmm.
Right now, we have more than 400 individual investors across our funds, and the outreach has been tremendous as of late because of our ability to continue to deliver outsized returns.
Yeah, absolutely. Can you talk a little bit? So let's say that somebody comes in, they're investing with you now as an LP. What type of, and I know this is a really difficult question, but what types of returns are you typically seeing in a fund? And then talk a little bit about the hold period. So someone comes in, they say, look, I'm just would rather piggyback on your success. I'd like
Yeah.
to invest. What can that investor expect in terms of distributions, hold periods, and what they might see as being an LP?
Yeah. So just for clarification, when you say invest in a fund, do you mean a Crystal View fund or a
Yeah.
non-Crystal View fund?
Yeah,
'Cause
yours. Yeah, yeah. I'm talking specifically about being
okay.
an investor with you.
Yeah.
Thanks.
Not to be cute, but I think the returns may vary between the two. Uh,
Absolutely.
so what we do is typically our guidance is high teens, low 20s. That's kind of
Hmm.
how we underwrite our projects. I will say, and I have to caveat this with past performance isn't indicative of future performance,
Hmm.
but on average, our exits have averaged more than 55% IRRs. And we're
Wow.
underwriting to, again, low 20, high teens level returns. So we take great pride in under promising and over delivering for our
Hmm.
investors. Along the way, we're typically hitting high single digit, low double digit cash on cash returns across our vehicles as well. So it's a current pay, which is paid out quarterly,
Okay.
ranging from 8 to 10% cash on cash. And then as we exit investments or we have liquidity events through refinancing activities, we're typically making distributions. We're either reinvesting or making distributions to our investors. So, kind of putting things in context, I think this answers your question. What kind of liquidity can they expect as they invest? Like in our fund two, through the form of special distributions, return of capital, and preferred returns, we've raised about 58 million, and we've returned north of 60 back
Wow.
to investors, and that was
Hmm.
a 2018 vintage fund. We still have 125 million plus in assets under
Wow.
management within that vehicle, and we're still throwing off the preferred return and continuing to execute on the business plan. So in an ideal world, that's what we're looking to achieve for our investors. These are longer term vehicles in nature, 10 plus.
Hmm. Hmm.
But Fund One, we exited in about 6.5 years and hit a mid 40s level IRR within that fund.
Wow. Yeah, that's pretty compelling. And a lot of work and a lot of effort going into it. And as you mentioned, I was at your investor event, and it's incredible to see your team and understand the expertise that everybody has, and the interest as well. One thing I really enjoyed hearing was that many of your staff members invest and have a little bit of skin in the game in terms
Sure.
of being involved in Crystal View, right?
Absolutely. I think that's a big piece of the puzzle here that you just hit on. And that's our mantra here, Heidi, is think like an owner. And the only way you're going to think like an owner is when you have skin in the game.
Hmm.
And for some of these folks, these checks may not seem huge, but for them, that's a large portion of their net worth. It really shows that they have conviction in what we're doing. They believe in what
Yeah.
we're doing. They believe in this culture of winning that we've
Hmm.
built at Crystal View, as do I. And that's why I continue to put a big share of my personal net worth in as an LP on the same terms as everyone else. I'm not getting any preferential treatment or there's no special unit class for me. What you see in the PPM is what I get to invest in as well. And actually, some folks have better unit classes than even I do. And I'm okay with that because I want an alignment of interests with my partners, with the investors who have entrusted us here at
Hmm.
Crystal View. And then frankly, for selfish reasons, I don't know where I could go out and get a better risk adjusted return than
Yeah.
being an LP in Crystal View.
Right. Yeah, I mean that's one of the things that's really fascinating about what you've built. Let's talk a little bit about tax strategy, given that this podcast is very largely about
Yeah,
slashing tax and the
yeah,
ability
let's
to
not forget about
use.
that.
Yeah, let's not forget about that. Especially it seems this year with the one big beautiful bill and a lot of these changes. How do these asset classes specifically support tax advantaged investing?
Yeah, well, honestly, I would rather defer to the professionals such as yourself, but I will give
I might
you
be a little
the
biased in that question.
yeah, I will give you the non-CPA, non-professional tax person's opinion as to why. I will say, and you know this quite well, in terms of the big beautiful bill and 100% bonus depreciation being back, it's generating some pretty sizable NOLs across our funds, which we're very
Yeah.
excited about, as our investors are very excited about. But
Hmm.
what's happening here is, breaking out the components through these cost segregation studies into personal property, equipment, and kind of segregating the land. The compelling thing here is the land of these within these two asset classes, especially how we invest, are in secondary and tertiary markets. So it's a lot easier to allocate a smaller percentage of that overall purchase price to the land. And you could back it up with comps, by the way.
Yep,
And
absolutely.
and the overwhelming majority is going to depreciable assets, which is allowing us to pick up the lion's share of the purchase price in the form of depreciation
Hmm.
that we get to pass through to our investors through their individual K1. So it's creating this scenario where they're receiving actual losses within their K1s, but they're getting these really nice distributions that we've talked about earlier.
Yep, exactly. I mean, yeah, this question does completely link into the cost segregation, which is very commonly part of the discussion on this show because we're all about tax strategy, and real estate is one of the most, if not the most, tax advantaged investment you can possibly be investing in. These asset classes, it's what's so fascinating is you've really pinpointed some huge parameters that magnify the benefits. Um, I think this is also why we've seen such a big influx in interest and demand for self-storage and mobile home parks or manufactured housing developments. Because to your point, take out the land, which is non-depreciable, but in many of these assets, all of then the improvements qualify as tangible personal property assets versus real estate, especially in these mini storage type projects, these drive-through metal type buildings. A lot of this stuff is a 100% bonus eligible. So you could be buying, a 10, a 20, a $30 million property and capturing $20 million in deductions. How that then correlates for investors, to your point, is this massive deduction where an investor could put in a certain amount into the fund that they're investing, but oftentimes the K1 is actually sending out a pretty big loss that's like significantly larger their investment. So not only are they getting tax-free distributions, normally those losses can then offset other gains, other
That's right.
revenue and income that those investors have. Um, is that something that you market to your investors in your conversations or you talk with them about as they're considering?
Yeah, so it's interesting, and you are right. And there is a designation about being a real estate professional and your
Yep.
ability to do that.
Hmm.
But, and this isn't a pitch, but I will say this, a lot of our Fund 2 and Fund 3 investors, as we execute on the business plan and maximize the net operating income of these assets, and we go to and dispose of them and sell them in the open market, they're generating some pretty sizable gains, especially if we do our job right.
Yeah.
So now you have to recapture that
Hmm.
depreciation. So that's the other side of that coin. And those investors come to us and say, wow, you did really well. I appreciate this distribution. Now, however, I've got this taxable event. Any advice on what I should do? And I say, well, I'll tell you what I would do, or tell you what I am doing, is I'm investing in our Fund 4 because we're at the beginning stages now where those NOLs are highly stacked on the front end. And that's
Mm-hmm.
offsetting those gains from the K1s of those earlier vintage funds that are having those liquidity events from those asset sales.
Yep.
So that's kind of a way to balance that out and to kind of counteract that taxable gain, which is working
Yeah.
well for me personally. And some
Yeah.
investors are taking advantage of it as well.
It's exactly the conversation we're having. There is a lot of concern with investors about recapture and about the capital gain, the increase in capital gain tax that may be incurred at the time of sale, whether it's their own asset or whether it's in this type of a liquidation in your one of your funds. But to your point, we always tell people, yeah, it's like there's the joke that real estate investors always just seem to be addicted to the next deal. Uh, Part of that is out of necessity to continue to grow those investments, to grow personal net worth. And that is by continually reinvesting, reinfusing that, and then using those losses to offset the gains. And so it's very cyclical
Yep,
and something to be aware of. But I'm glad you brought that up because recapture is definitely a topic that we run into and people feel concerned about.
sure.
What do you think are the biggest opportunities that you see coming in the next 3 to 5 years within value add real estate, or whether it's the sector or others?
Yeah, great question. I mean, again, I still see a lot of value, a lot of opportunity in what we're doing, in our core kind of pure play niches being the self storage and the manufactured housing because they are still fragmented and they will be fragmented for at least the foreseeable future, let's say 5 years. 10 years plus, I don't know where we're going to be. But until that time, we see a real opportunity to continue to go out there and roll these assets up and aggregate and execute that business plan as we have over the past decade plus. We are seeing some other unique opportunities, which we call niches within niches. And I'll give you a couple examples of those. On the manufactured housing side, we own and we are looking at pursuing RV parks, which are kind of nuanced, that are more of a business, but have very similar fundamentals of the manufactured housing
Hmm.
asset class with marinas. Um, on the storage side, we do own and we're looking to pursue kind of incubator space, small bay industrial. Think about larger kind of storage units, 1,000 to 1,500 square foot plus, and that range that are leased to your local electrician and your local plumber. There is virtually no new supply of that product coming to market in most geographies, which allows an interesting supply demand dynamic where you could really grow your occupancy and grow your rents without competing like you would in the traditional storage space, where in some markets it is oversupplied. We also are seeing industrial outdoor storage opportunities, which is kind of, think about it like semi laydown space, these large lots where it's just open outdoor parking, equipment, semis, trucks, buses, um, about business equipment, things of that sort, where we're buying those assets and we could kind of institutionalize operations, put in real gates, utilize AI to have a gated access, a code, a
Okay.
card where they can only access it if they're current on their rent, those type of things. So I think given our core competency, kind of gravitating and pivoting into these niches is going to be a real opportunity for us to continue to scale, continue to find great value in the marketplace, and continue to deliver great returns for our investors.
Yeah, that's exciting. I
Yeah,
mean, I love that, and that's one thing again that I really appreciate about what you're doing is being innovative and staying kind of ahead of the market. I think in terms of seeing those opportunities. So, with that, talk about a little bit about what Crystal View Capital is planning for any new directions, funds, or any other. You kind of talked about sectors, but right now we're recording. We're getting right now down towards the end of the year for 2025, so maybe there's some opportunity for 2025 still. There's a little time left, but also I'm sure many listeners will be listening to this in 2026 as well. So for our listeners, what are you guys doing, and what do you suggest, or what are things you're excited about with Crystal View that investors should know about for this year and next?
yeah. So in terms of right now we're approaching Thanksgiving, and not much time left in the year, which is crazy how quickly it's gone.
Yeah.
But we are in the process of winding down the raise in Fund 4. We've raised north of 100 million, give or take, in equity,
Mm.
and we anticipate closing this vehicle around the first or beginning second quarter of 2026. And from there, we are going to launch a new vehicle or vehicles that kind of focus on, again, these niche strategies of manufactured housing communities, storage, and then kind of these hybrids we just discussed around
Hmm.
RV, and also the IOS and small bay industrial. We're debating kind of bifurcating the strategy in two different vehicles, or staying in kind of the consolidated vehicle, which aggregates all of the asset classes together. We
Hmm.
also have had a lot of interest around an evergreen fund, Heidi.
Mm.
So what that would mean is a lot of our investors, it's interesting being a fund manager. I come from the restaurant business, and I
Oh,
remember
okay.
I remember, and I'm going to kind of create an analogy here. So my father, him being a restaurateur, I remember him always saying, no matter what you do or how perfect the food is, how great the service is, inevitably somebody is going to complain. And I'd be like, well, why would that happen? And well, he was right, and it also applies to what we do. And I'll give you an example. We'll buy an asset right. We'll execute the business plan. We'll have a wonderful exit in the 40s. We'll make a distribution. Inevitably we will receive a phone call from somebody that says, yeah, well, obviously good return, but I'm upset. Why are you returning my capital? I want you to continue to do this forever. So I think my job as a GP is to find out what our customers want and give it to them. Because a lot of
Mhm.
these folks, yes, they like distributions, but they want long-term wealth accumulation, and they're very tax conscious, and they would prefer we don't sell assets. And I will tell you, one of the biggest mistakes I've made is selling assets, but I have to,
Yeah.
pursuant to our fund documents. And I look back at some of these sales. I was very happy at the time, but 2, 3, 4 years pass, and you think, wow, look what that's worth today. So we may create a evergreen fund that goes on in perpetuity. So that's generally what we're thinking. But I will say this: Fund 4 has performed exceptionally well, and as we close that out, the interest has been really remarkable. And
Hmm.
for anybody who is interested in investing, that window is going to close quickly. We would love the opportunity to serve you in Fund 4 or in subsequent vehicles. But as Fund 4 closes down, there is a lag in between formation of that new vehicle and ramp up of acquiring assets, executing the business plan, where that cash flow starts to kick in again. So this
Hmm.
is a unique opportunity to get in at the end, where you're buying into an existing cash flow, and you're going to have these nice tax advantages that we just discussed.
Yeah, fantastic. Well, that's real exciting. I can't wait to share this one and get this out quickly so that our investors and I can share it because, like I say, I have so many people looking for opportunities still before the end of the year, and I'm sure you'll have more coming into next year that people can get involved with. But before we wrap up, tell or share a little bit with our listeners about what the best way is to get in touch with your team, with your group, or you, and how they can learn more about your funds.
Yeah, so visit our website, www.crystalviewcapital.com. Reach out to our investor relations team, Ben Brundage, who leads up investor relations, and you can email him at invest@crystalviewcapital.com.
Beautiful. Perfect. Well, Matt, thank you so much for being here. I really appreciate the time and I'm really excited to share this with our listeners and begin to share out more about what you guys are doing because I think it's fantastic.
Well, we appreciate you, Heidi, and thank you for letting me be a part of your program today. Happy
Absolutely.
Thanksgiving to you.
Thank you so much. You too. All right. Thanks.
Thanks.